Okay, so when we sit down to talk about the insurance sector, the expectation is usually, well, it's pretty muted, right?
Right. Yeah. You're thinking actuary spreadsheets.
Endless spreadsheets, slow-moving data, maybe a little small talk about the weather. It's supposed to be the boring part of the financial world.
It is.
But what we're looking at today with this Travelers Company's report for Q4 2025 is frankly just startling.
Yeah.
It feels less like an insurance update and more like a high-growth tech story that just happens to be wearing like a 170-year-old suit.
It really does feel that way.
Right.
In this industry, you look for stability, you look for predictability, you don't usually look for fireworks.
Yeah.
But Travelers ticker, TRV, for anyone tracking it, they didn't just report earnings this morning, January 21st.
Yeah.
They basically took the grading scale, break it over their knee, and just threw it out the window.
I want to get to the headline numbers right away because they are staggering. The Wall Street consensus, the experts who model this for a living, they were looking for a core income per share around $8.34.
Which would have been a solid quarter. A really good quarter, actually.
A great number. Everyone goes home happy. But Travelers came in at $11.13 per share.
11.13.
That is a beat of nearly $3 per share. And their core return on equity hit 29.6%.
Which is just unheard of. To put that nearly 30% ROE into perspective for you, a 15% return is usually considered, the gold standard for a mature insurer.
If you're hitting 15, you're winning.
You're winning, hitting nearly 30. That puts them in a completely different stratosphere of profitability. It's the kind of margin you expect from a software company, not from the company that insures your car.
Exactly. So the mission for this deep dive is to answer the big question, how? Is this just a fluke because the hurricanes missed them in Q4? Did they get lucky with the weather? Or is something fundamentally different happening under the hood at Travelers? Because when I see a company this old posting numbers like this, I have to wonder if the business model itself has just shifted.
That is the key question. And while the weather certainly helped, and we'll get to that, the real answer, I think, lies in what the CEO, Alan Schinzer, is calling Innovation 2.0.
Right.
We are seeing a legacy carrier pivot hard into artificial intelligence in a way that is actually moving the needle on the balance sheet.
So this isn't just a press release about exploring AI.
Not at all. This is AI showing up in the profit column.
Okay, we're going to unpack that, especially the partnership with Anthropic. That really stood out. But before we get to the robots, we have to look at the money.
Right.
To understand how they got to $11 a share, we have to look at the two engines of insurance.
Right. It's so important to remember, insurance companies make money in two distinct ways. Engine one is underwriting.
The core business.
The core business. Collecting more in premiums than you pay out in claims and expenses.
Selling that promise of protection.
Exactly. And engine two is the investments, the float. They take all that cash they're holding for future claims and they invest it to earn interest until it's needed.
And usually one of those is doing better than the other, right? They trade off.
Precisely. Usually one engine is carrying the load while the other one is idling a bit. But this quarter, Travelers fired on both cylinders at maximum capacity.
Okay, so let's start with underwriting. The metric that really matters here is the combined ratio.
The holy grail. For anyone new to this, it measures profitability. Below 100 is profit. The lower, the better.
And Travelers reported an underlying combined ratio of 82.2%.
Which is spectacular. Basically, for every dollar of premium they took in, they kept about 18 cents as pure underwriting profit. That's before even touching the investment income.
And what's the context here? Is this a one-off?
Well, that's what's so important. It improved by nearly 2 full points from last year. But more than that, this is the 5th consecutive quarter. Their underlying combined ratio has been below 85%.
Okay, so that tells me this isn't just we had good weather in December.
No.
5 quarters is a pattern. It means they are consistently pricing risk better than the cost of that risk.
It is a trend. They generated $2.2 billion in pre-tax underwriting income. That's up 21%. That is just pure operational excellence.
So that's engine one roaring. What about engine two, the investments?
A huge tailwind. Their net investment income after tax rose 10% to $867 million.
Wow.
But the number from the slide deck that you really have to pay attention to, the one that signals the future health, is the portfolio size. It's grown to $106 billion.
$106 billion. That is a massive amount of capital just working for them.
And the CFO pointed out this crucial detail about new money rates. Think about it this way. Travelers owns a lot of bonds. Some were bought years ago when rates were tiny.
And now they have to reinvest that money as they mature.
Right. And the yields they can get on new investments today are about 70 basis points higher than the yield on the bonds that are falling off the books.
So even if they do nothing just by letting the calendar turn, their income goes up.
Exactly. It's a built-in earnings escalator. They're projecting about $3.3 billion in after-tax fixed income for 2026.
That is a wildly powerful position. It's passive income on a corporate scale. But look, every big insurer has a bond portfolio.
Sure.
What I want to drill into is this Innovation 2.0, because CEO Alan Schnitzer spent a huge chunk of the call on this. What makes Travelers different here?
This is where it gets fascinating. Schnitzer described the last 10 years as Innovation 1.0. That was the foundational work, right? Getting data organized, moving to the cloud.
The plumbing.
The plumbing.
Yeah.
Necessary, but it was just table stakes. Innovation 2.0 is about deploying that data with AI. And they aren't just dipping a toe in. They announced a partnership with Anthropic.
Right, a heavy hitter in the AI world. They make the Claude models. What is an insurance company doing with that kind of firepower?
Well, they're deploying AI assistants to 10,000 employees.
10,000.
10,000. Specifically engineers, data scientists, and analysts. Schnitzer called it empowering them with personalized, context-aware AI.
Wait, 10,000 employees? That is not some pilot program in a lab somewhere. That's a massive scale deployment.
It is. It's a huge portion of their workforce getting an AI co-pilot. And the goal isn't just to write code faster, it's to fundamentally change how they handle claims.
Okay, so how does this actually touch the customer?
The most tangible example is in claims processing. I saw a stat in the transcript that actually made me pause.
Me too. More than 50% of all claims are now eligible for straight-through processing.
Straight through being the key phrase. It means no human involved.
So the old way was, a claim goes in a pile, an adjuster reads it, makes some calls.
Slow, expensive, prone to error. The new way. The system gets the claim, validates it against the policy, checks for fraud with AI, assesses damage from photos, and pays it, all without a human hitting the keystroke.
So half of all fender benders, storm damage, that kind of thing, can theoretically be handled entirely by machine?
Theoretically. And in practice, customers are choosing that automated path about 2/3 of the time. But even cooler. Just last week, they launched a natural language generative AI voice agent.
For what?
To take the first notice of loss calls.
Wait, so if I get in a car accident and call the 800 number, I might be talking to an AI.
You might. And not a press one for claims robot, a conversational AI that can actually talk to you.
That feels risky. I mean, you've just crashed your car, you're shaken up. Can an AI handle that with empathy?
It's a huge question. But management says early adoption is exceeding their expectations. The AI handles the intake, gathers the facts. And this explains the efficiency numbers we're seeing.
Right. Their call center population is down by 1/3.
A full third. And they're consolidating from 4 claim call centers down to just 2 this year.
Okay, hold on. This all connects back to the financials. Usually when you hear tech transformation, the expense ratio balloons.
You see a lot of spending.
Right, spending money to make money. But Travelers' expense ratio is stable, around 28.5%.
You spotted it. The efficiency gains, fewer call centers, less manual processing, are offsetting the tech costs. These gains show up in what's called loss adjustment expense, or LAE.
The cost of processing a claim.
Exactly. If you lower that cost while keeping premium steady, your profit margin expands. It's the holy grail of operations.
And I'm guessing better data just feeds back into the whole system.
It's a flywheel. Better data leads to better pricing, which leads to better profitability. It's something a smaller insurer just can't compete with at this scale.
So Innovation 2.0 isn't a buzzword. It's reshaping their actual physical footprint and their workforce. Okay, let's pivot to the business segments, because the real money story here is the dramatic turnaround in personal insurance.
You mean home and auto? Yeah.
A couple of years ago, this was the problem child of the portfolio. They were bleeding money on it.
It was dire. The combined ratio for personal was over 100. They were losing money on every dollar of premium. But look at Q4 2025. Segment income was over $1 billion.
From a loss to $1 billion in profit. A massive U-turn. How did they pull that off?
The star of the show is homeowners insurance. The combined ratio dropped to an incredible 60.3%.
60.3%. That implies a 40% profit margin on home insurance. That sounds unbelievably profitable.
It is exceptionally profitable, but you have to see how they got there. It wasn't magic. It was aggressive management. Their renewal premium change was 16.7%.
Ouch. So my bill, as a Travelers customer, went up almost 17%.
Correct. On top of other big increases. But it wasn't just price. They also aggressively managed exposure. Since 2020, they've cut the number of property policies in force by 10%.
Meaning they just dropped customers?
They looked at high-risk zones, wildfire areas, coastal storm zones, and essentially said, we're out. They shrunk the book to improve the quality.
So they raised prices drastically and then dropped the riskiest customers. That explains the profitability. But isn't there a limit? You can't raise rates 17% forever.
That's the critical question. But Travelers says retention is holding up reasonably well. And there is a light at the end of the tunnel for you, the consumer.
Okay.
Management said that home values are now largely aligned with replacement costs.
Meaning the price hikes have finally caught up to the inflation of lumber and labor.
Yes. So they expect rate increases to drop into the single digits in 2026. The pain period might be ending.
That's a relief. What about auto?
Auto was healthy too. Combined ratio improved to 89.4%. They're seeing favorable frequency, so people are crashing less. And the severity, the cost per accident, is moderating.
So personal insurance is back. What about the big moneymaker, the commercial side?
Business insurance is still the steady giant. Segment income was nearly $1.3 billion. But what stands out here is the discipline. They mentioned national property premiums actually declined.
Declined. In a growing economy. Why?
Because Travelers walking away from bad deals. They said it explicitly. If the price or the terms aren't right, they won't write the business.
That is the discipline you want to see. It's easy to chase revenue. It's hard to say no.
And their core clients are staying. Retention is excellent at 85%.
Before we move on, I saw a note in the bond and specialty segment about cyber risk. They bought a company called Corvus.
Yeah, that connects right back to the innovation theme. They've fully integrated Corvus. What's interesting is they're not just selling a policy that pays out if you get hacked.
What are they doing?
They're offering services like always-on threat monitoring and dark web surveillance.
Dark web surveillance. Sounds like a spy movie.
It does, but it's practical. They monitor for leaked credentials. It shifts the relationship from payer to partner. If they can stop the hack from happening, they save everyone a massive headache and a huge claim.
Smart. It's preventative medicine for cybersecurity. Okay, so we've painted a very rosy picture. Record earnings, AI revolution. Let's play devil's advocate. What are the headwinds?
The biggest wild card is always catastrophe. See Canties. And Travelers is being very realistic about this. They've raised their SET-load budget for 2026. They're planning for a combined ratio impact of 7.8%. Just from catastrophes.
Which is higher than their averages. So they are betting the weather is going to get worse, or at least stay this volatile.
They're acknowledging reality. They aren't hoping for the best. They are budgeting for the storms. And to address that, they made a big move with their reinsurance strategy.
Reinsurance being insurance for insurance companies.
Exactly. They changed their big cat excess of loss treaty. They lowered the attachment point from $4 billion down to $3 billion.
Okay, unpack attachment point for us.
Yeah.
What does that mean practically?
Think of it like a deductible on your car insurance. Last year, Travelers had to pay the first $4 billion of SIGT losses out of their own pocket before their reinsurer kicked in.
Okay.
For 2026, they lowered that deductible. Now they only have to pay the first $3 billion.
So they're buying protection that kicks in sooner.
Exactly. It costs a bit more, just like lowering your car insurance deductible raises your premium. But it means they are much better protected against a really bad storm year.
Yeah.
It smooths out their earnings volatility.
Which investors love. They want
Right.
predictable earnings, not, oops, a hurricane ate our profits.
Precisely. The other risk they mentioned is toward inflation, social inflation. Lawsuits getting more expensive, huge jury awards. The CEO said the legal environment is still very challenging.
Yeah, that's a structural headwind for the whole industry. Even with some reforms, it's still a litigious world.
It is, and they have to price for that legal risk constantly.
So finally, let's talk capital allocation. When you make $11.13 a share, you're sitting on a huge pile of cash. Where does it go?
And they are giving a huge chunk of it right back to shareholders. They bought back $1.65 billion in shares in Q4 alone.
$1.5 billion in one quarter.
And they plan to buy back another $1.8 billion in Q1 2026.
That is aggressive. That's billions of dollars of their own stock they're retiring.
It signals massive confidence. They're betting on themselves. Part of that is funded by selling their Canadian operations, but it's still a very strong signal.
And the book value?
Reached an all-time high of $158.01 per share, up 14% year over year, which is really the true measure of an insurer's worth.
One small technical thing I saw in debt, they're changing how they issue it.
Yeah, a subtle sign of maturity. They used to issue debt every other year. Now they're moving to an annual cycle. It just smooths out their capital structure. It's a boring detail, but it shows a management team focused on consistency.
Boring is good in insurance. Boring pays the dividends.
Absolutely.
So let's pull this all together. We started this asking if this $11 earnings surprise was just a fluke. And it sounds like the answer is a definitive no.
It's definitely not a fluke. This is a company firing on all cylinders. You have record premiums, massive underwriting profit, and an investment portfolio kicking off nearly $1 billion a quarter.
And then you layer this Innovation 2.0 on top of it all.
And that's the differentiator. I mean, if they can successfully automate 50–60% of their claims workflow with AI, they're building a competitive moat that's going to be very hard for smaller insurers to cross.
That's the so what for me. We've heard so much about the hard market and insurance prices going up, but this report signals that while prices might be stabilizing, the big carriers like Travelers have used this time to become these incredibly efficient profit machines.
They're leaner and meaner than they were 5 years ago. They have used the crisis of inflation to sharpen their whole operation.
It really challenges the perception of insurance as this, dusty, old-school industry. Which leads me to my final thought for you to chew on.
Okay.
We think of Travelers as this 170-year-old institution, the red umbrella, very traditional.
A staple of the Dow Jones.
Exactly, but they're automating half their claims. They're partnering with Anthropic. They're using voice AI to talk to customers. At what point do we stop valuing them as a traditional insurance carrier and start looking at them as a tech company that just happens to manage risk?
That is the multi-billion-dollar question.
Yeah.
If they can maintain this ROE near 30%, the market might have to re-rate the entire sector. If they prove they can sustain tech-like margins, they might eventually command tech-like valuations.
Something to think about next time you pay your premium and see that red umbrella. That's it for this deep dive into Travelers Monster Q4. Thanks for listening, and we'll catch you on the next one.